All right, if you're a trader, you know exactly what I'm talking about. That feeling of just staring at a screen, a total mess of chaotic lines, just hoping for a clear signal to pop out. Well, today we're going to cut right through all that noise. Let's dive in and figure out how you can start trading cleaner and a whole lot smarter.
So, does this look familiar? Yeah, I thought so. It's that tangled web of indicators, right? All of them screaming for your attention at once. And look, we've all been there. We've all thought, you know what? Just one more tool, that's going to be the key. But what happens? You just end up with a bunch of conflicting signals and, total analysis paralysis. It's a super common trap, but believe me, there is a much better way.
Okay, let's just bust a huge trading myth right here, right now. More indicators do not equal more profits. It's just not true. In fact, a lot of the time it's the complete opposite. It just creates this fog of confusion, this false confidence, and that leads to really bad decisions. The real goal here isn't to get more information, it's to get better, clearer information.
So if piling on more indicators isn't the answer, then what is? What's the secret? Well, it all comes down to one really powerful principle: confluence. Seriously, this one concept is going to be what transforms your chart from that chaotic mess we just saw into a clear, readable map, a map that points you to high probability opportunities.
And the key word here, the one you really got to remember, is independent. Think about it like a court case, right? If one witness tells a story, that's interesting. But what if you have three separate, totally independent witnesses who don't even know each other, and they all come in and tell the exact same story? Now that is a powerful case. And that, my friends, is exactly what confluence is in trading. It's just different types of evidence all pointing to the same conclusion.
Okay, let me show you how this actually works in practice. So, step one, you look at the chart and you see the market structure is pointing to a really strong historical support level. That's piece of evidence number one. Then, you look at your momentum indicator, something like the RSI, and it's signaling that the asset is oversold. So, it might be due for a bounce. That's piece number two. And then finally, a bullish candlestick pattern actually forms right at that level, confirming that buyers are stepping in. You see? Each piece of evidence is different, but when you put them all together, they build this incredibly powerful case for a trade.
Okay, so this all sounds great, right? But how do we actually build this into a practical strategy? Well, it all starts with choosing the right tools for your toolkit. And remember, we're not trying to collect the most tools. The goal is to have just a few high-quality ones that each serve a very unique purpose. It is all about quality over quantity.
Now this here is a classic mistake I see so many traders make. Look at the left side. That's a redundant toolkit. You've got RSI, stochastics, and CCI. They're all basically momentum oscillators. They're all telling you pretty much the same thing: how fast the price is moving. It's kind of like having three witnesses who all just heard the same rumor from the same person. It's not new information. Now look at the right. That's a complementary toolkit. A moving average tells you the trend. The MACD tracks momentum. Bollinger Bands measure volatility. See the difference? Each one gives you a unique piece of the puzzle.
So what you're really trying to do is build a dream team of indicator specialists. You want one for trend direction, another for momentum or speed, one for volatility, and another one for conviction or volume. This table right here, this is your guide. Seriously, go ahead and screenshot this right now. Think of it as your cheat sheet for building a really powerful, non-redundant trading strategy.
But look, even with the absolute perfect toolkit, there is one rule that stands above everything else. It is the ultimate source of truth in the market, and you have to get this right. So let's get into it.
I really want you to let this sink in for a second. Every single indicator on your chart, where does it come from? It's calculated from one thing and one thing only: price. That means they are just a reflection of what price has already done. They are lagging. Indicators follow, they do not lead. And that's exactly why price action, what the price itself is doing, has to be your final, absolute confirmation before you ever pull the trigger on a trade.
Let's walk through another high-probability setup so you can see what I mean. Okay, so maybe an indicator like the RSI is showing a bullish divergence. That's a great hint, right? It's telling you that a downward trend might be losing steam. But, and this is the important part, we do not act yet. We wait. We wait for price to confirm it. So first, we need to see the price actually break a key resistance level. Then, we look for a strong bullish candlestick pattern to show that buyers are actually interested. And finally, a big surge in volume tells us that the big money, the big players, are backing this move. You see, the indicator gave us the hint, but it was price that gave us the green light to go.
All right, So we've covered the main principle, we've talked about the tools, and we've nailed down that golden rule of confirmation. Now let's tie this whole thing together into a practical framework you can use for smarter and, hopefully, more profitable trading.
Okay, before we wrap this up, let's quickly cover some common pitfalls, things you really need to avoid. First up, stop using the default settings. You need to tune your indicators to the specific asset and time frame you're trading. Second, and we've said this a lot, never, ever blindly follow a signal without confirmation from price. Third, you've got to learn to spot divergence. It can be an incredibly powerful early warning of a big trend change. And last but not least, avoid over-optimization. That's when you tweak your settings so they work perfectly on past data, but guess what? It's going to fail in the future, because the market is always changing.
You know, when it's all said and done, it really just comes down to this one golden rule. Simplicity is clarity. That's it. Limit your chart to just 2, maybe 3 truly complementary indicators that you know inside and out. Your job is to master your tools, not just collect them. That is the real path to building confidence and consistency in your trading.
So, the power is now in your hands. It's up to you. And I'll leave you with this question. I want you to go look at your own charts right now. What is the very first step you're going to take to simplify your strategy and start trading with the true power of Confluence?